I speak with e-commerce brands every single day, and the most asked question I get is, Jad, how much is my brand worth? The reality is there's a lot more than goes into evaluation than just your financials. Obviously, your financials are very important, but a lot of the times when I speak to e-commerce founders, they simply send me their P&L or some sort of financials and tell me, hey, these are my numbers. Well, how much can I exit for? The reality is there's a lot more that goes behind these numbers and behind the multiple than just knowing what your number and your niche is. You can have two brands within the same niche with the same age and similar financials that sell for two completely different valuations, and I'm going to go through what KPIs investors look for when acquiring a brand and ultimately how you can optimize your brand to make it sellable and to go to market for the highest price. So I'm Jad, I'm the co-founder of Ecom Swap, where at Ecom Swap we've helped over 100 D2C brands exit. My background's in e-commerce. I've been doing e-commerce for around 7 years now. We have our own brands, we're acquiring brands, we're building a portfolio, so we're very much in the space, and I'd like to say that, you know, I understand what I'm talking about in this video. So yeah, keep up and we'll dive into what KPIs investors will be looking for and how you can optimize these KPIs to ensure that you exit at the highest possible multiple. I think the first question that we get in a lot of cases is, why are we looking at the bottom line? Why are we looking at the net profit? And why are we not looking at how much revenue my brand is doing and basing the multiple on the revenue? So I think that's a very common misconception, and it's important to understand, you know, what category you're playing in, what field you're in, and understand why your business is being valued on this metric and not on revenue. So the first thing I'd like to say with that is, if you compare SaaS or different fields where there are indeed revenue multiples and not EBITDA multiples, there's a very simple reason this is the case. Let's put it into context. You know, in e-commerce, most brands can't afford to burn cash. They work, let's say you're running on paid acquisition. That means you're running ads on, let's say, Meta. If your margin is low, that's generally correlated to your CPA being too high. And your CPA being too high is a clear metric that your brand is underperforming, and that's also going to be reflected in lower multiples. So taking that number into consideration makes total sense. There are certain very rare cases where, you know, you have a brand and you're burning a lot of cash because you're building on your LTV and you're building something long term. And in those cases, revenue can be taken into consideration, but even then, it's generally a burn rate that's short enough for you to be able to base the multiple on the EBITDA, and you would actually be able to use that to basically, that would just correlate into a higher EBITDA multiple. So now let's look into what KPIs investors are going to prioritize when looking at your business, and what KPIs are going to essentially negatively or positively impact your valuation and that are going to weigh in the most to make your business attractive to investors. The first one would be growth. So what does your growth look like? Generally, we look at this over a year basis. If your business is a bit younger, we will look at it on a month over month basis. It's important to understand that sustainable growth is always prioritized. We don't want to see any dips in the sales or the profit, of course. If it's a business with a lot of variation in sales, let's say, you know, you're scaling up one month, you're doing 10,000, the next 50,000, the next 5,000, that's not going to be something that's very much appreciated, as it's something with a lot of volatility. So you want to make sure, number one, your volatility is as low as possible. And also, if you can mitigate seasonality to have that as little as possible, that's also something that's going to help significantly. Obviously, there are some certain products that are going to have more seasonality than others, but it's important to really try to create an ecosystem and a brand where essentially your sales are consistent throughout the year and where there's no significant dips. Obviously, talking about Q4, most brands, you know, do a lot of their revenue in Q4, so that's something that's accepted. But it's, you know, if a brand has 80% of their revenue in Q4 and 20% amongst the rest of the year, that obviously represents more risk, and then it's going to cause some issues with timing, etc. So that's not something that's appreciated by most investors. Along with that, we want to see sustainable growth. I think that's something that a lot of founders don't take into consideration. It's important to scale up your growth and you scale up your brand in a sustainable way, where you're not having a huge pike in revenue and then dropping down, as that's definitely something that kills the value of your brand. It's important to have growth that's sustainable month over month, year over year, and that's going up in a sustainable way and not going up and down. The second KPI, which weighs in very significantly, is obviously LTV. So what's your returning customer rate? What's your funnel for keeping your customers? It's essential to understand, you know, we see a lot of brands that today are running with a very mediocre returning customer rate. A lot of the time this translates into, at the end of the day, you just running a funnel rather than a brand. So that's going to be reflecting into a much lower multiple than if you had returning customers and an actual strong LTV. So obviously ways of optimizing this is, and I think a lot of issues that I see brand owners do, definitely sending out campaigns that are full of sales and not giving any value, and thinking too short term. Being able to actually develop an ecosystem again and a funnel funnel where you're nurturing your audience and your customers and actually building around the brand is extremely important and will correlate most definitely in a much higher multiple at the point of exit. So yeah, LTV is definitely one of the most important KPIs that's looked at in a brand. The nature of certain products is going to affect this more or less. Obviously, if you're in a consumable space, you're going to have, or you're selling consumable products, naturally your LTV is going to be higher because people have the need to come back and repurchase that product. But vice versa, being in a space where you're selling one-off products, it's going to be harder to bring up that LTV. But putting effort into, number one, increasing your product range to accommodate for this LTV and to push for this LTV, whether that's adding new products, pushing consumable products, or adding certain processes in place to ensure that you have the right product range and the right infrastructure to push this LTV. But number two, also in your funnels, providing as much value as possible in your emails. Let's say you, depending obviously on the size of your business, etc., but running 2 value campaigns where you're actually nurturing your audience and providing value on your product. Let's say you're running a skincare brand, you're giving them routines, you're giving them certain tips and secrets, and then here and there, maybe once a week or bi-weekly, sending out sale funnels. One mistake I also see a lot, I think, with this is, again, for example, and this correlates to LTV, but also correlates to the brand valuation pretty significantly, is giving discounts that are too big. Let's say you're selling $25 product and it's discounted from $100. The sustainability of this offer is pretty low because, coming Q4, you don't have much margin to actually give out extra discounts, or maybe you can bundle things, etc. But it's not going to be as impactful as building a brand with a lower discount and just having a different positioning in the offer that allows you to scale further. So that's also something that I see a lot as an issue. So I think that comes down to fixing your funnel, which correlates partly with LTV, also with AOV, and also with brand positioning, which is essential to building long-term sustainability, and obviously will correlate into acquirers being much more confident when placing an offer on your brand or looking at your brand. Now, one other part that's very important is definitely diversification in acquisition channels. So I think it's easy to get comfortable with one sales channel and just keep pushing on that. And generally this correlates into basically brand owners not diversifying their acquisition channels well enough. And I think it's essential for anyone to diversify that as much as possible. So let's say you're running paid acquisition on Meta. We see so many brands running just that and not trying to and maybe, adding a bit of Google ads for retargeting or for search, but not actually going a step further and trying to diversify that. And again, this comes down to risk. If all of your traffic, all of your customers are coming in from the same source, let's say Meta, and then you have an issue with Meta, whether it's a ban, whatever it is, that comes into root, your business is worth nothing. So that obviously represents a huge risk for anyone coming in and making an investment, as opposed to, for example, having 40% Meta and then adding in some Amazon, adding in organic, maybe working on the SEO, which is obviously a bit more complex long run. I think that's interesting. Building out your social media pages so that you actually build a following on there and build a community around the brand. And being able to do that will definitely correlate into lower risk and much higher multiple. So yeah, that's, I think, one of the biggest mistakes I also see is definitely founders not trying to diversify their sales channels well enough. And that's also a risk for them because, we see the amount of times I see people with a brand running on Meta and then all of a sudden, boom, their ads start to tank. Maybe the CPA goes up, maybe they have a ban, whatever issue it is, that obviously correlates into the brand, into some decline and kills the brand valuation. But also obviously, even without that happening, that's still something that's taken into consideration by investors, and that will cause essentially a lower multiple. Now, one other part is definitely transferability. So when I say transferability, it's understanding what the team structure is and how easy it will be for any acquirer to take over. Again, I think the biggest issue I see here is founders trying to do everything themselves. And I think even from a perspective of running the business, having things diversified and being able to run your business as passively as possible in the micro and just focus on the macro is definitely what's going to bring you to the next step. And that's also something that obviously will impact you very significantly. Having, the less reliant the business is on you, the lower the risk for the acquirer, and that translates into a higher multiple on the exit. So being able to build out your teams on every aspect possible, I think is very important, especially on the, creatives, media buying, emails. I think on the most important acquisition parts, that should definitely be in-house or through agencies or through freelancers, however it is. I guess this really depends on scale, but it's definitely something to take into consideration and to build as early as possible, because for the valuation, that will definitely be a game changer. Now, one other part is definitely IP. So I think that's something that's definitely overlooked by a lot of founders, but being able to, even as simple as just getting your trademark to ensure that you won't have any oppositions to that, it's something that should be done as early on as possible, and that will help you with your exit. Simply to trademark, if you can get patents. Obviously, patents is a bit of a more complex process than trademarks, but at minimum, trademarking your brand and even as far as going and trademarking trademarking the content around the brand, etc. on the website, so that you actually have that moat and you're able to basically, you know, be in a position where there's a higher barrier to entry and you actually own your brand and there's no risks to that level. And we have seen a lot of issues with trademarks during exit, especially a lot of founders don't consider it, but when a more corporate buyer comes in, they're definitely going to look at definitely going to have a due diligence process where they have a law team coming in, and generally, you know, whatever their attorney or lawyers can come in and say, hey, actually on this end there could be an issue, there's a risk here, and these are risks that to most people, you know, most founders wouldn't even think of. But for example, we, you know, let's say we had a brand recently that had the name Coco, and that obviously caused some, and the acquirer actually had an issue when acquiring that brand because they had a lawsuit from Chanel, and that correlated into into them having to change the name, take down the brand, etc. So a lot of complications, and yeah, it's definitely something that a lot of investors will weigh in pretty heavily and look at. One more part that's essential is brand reputation, and this again, I think a lot of founders really just put it on the side and they think, okay, this isn't a priority, but I think there's so many quick fixes to this that aren't applied, and that really should be. And again, you know, if your brand has 2 stars or 3 stars on Trustpilot, that's a huge red flag. First of all, depending on how many reviews you have, of course, but it's going to take some time to turn that around, and this causes a lot of issues that people overlook from an investor's point of view. Acquiring a brand with a low Trustpilot or low review or brand reputation is extremely risky, and so that's definitely something that needs to be considered and taken into account. One last point to take into consideration is definitely the growth. I think planning your exit at the right moment is essential. You know, I think a lot of the issue I see is that a lot of founders decide to exit when things are starting to go in decline, or, you know, when things are starting to go a little bit south. And I think that's the biggest valuation killer, because in any exit, and the same way I think in any sale, the most important part of any sale is definitely leverage. And when you're selling and your numbers are starting to go down, that's a point where your leverage is at the lowest. And obviously from an investor's perspective, they know that the longer they wait, the chances are the numbers will keep going down and they'll end up, you know, either buying at a lower multiple or just pulling out. So I think timing your exit efficiently, where, you know, things are, with the perfect moments, it's always a bit hard to say, but where, you know, where things are not in decline for sure, where things are somehow growing. It doesn't have to be exponential growth, but it can be, you know, sustainable growth again. Planning it accordingly is essential, and yeah, I think it's important to have an understanding of where your business is at in terms of equity value, in terms of how much it can be worth, and planning according to that, so that when you do decide to exit the brand, and you have an understanding of exactly at every stage of the business how much your business is worth, and, you know, how much you can get out of it, which I think a lot of people overlook. I hope you guys enjoyed the video. I'm happy to answer any questions anyone has. I'll drop my Twitter in the caption below. Don't forget to like and subscribe. And on top of that, we also have a valuation calculator on our platform, ecomswap.io. I'll drop the link to our valuation calculator below. So if you want to just have an understanding, or it's a very rough idea, because obviously there's more that goes into it, but it should give you an idea of the worth of your business. So if you want to kind of test around and understand how much your business is worth today, feel free to click the link below on the valuation calculator, and you'll get a valuation directly through our tool. So yeah, I hope you guys enjoyed the video. Happy to answer any questions, and yeah, it was exciting to make the first video, a bit out of the norm, but definitely hoping to make some more. So happy to hear anyone's thoughts, and if you have any recommendations or videos that you'd like to see, topics that you'd like to explore, more than happy to answer those. So yeah, feel free to drop that in the comments, and like and subscribe, of course. Thank you very much.